So one of the stocks that I keep getting asked to do an update on is Disney, which we all know is struggling big time right now with the whole global health issue that continues to wreak havoc on not just the economy, but especially on any companies that have any kind of direct exposure to it, which we all know Disney definitely does have that with their many theme parks and resorts and of course studio business. Well, being that Disney is one of my largest holdings and the fact that they just reported earnings this past week, I thought now would be a good time to go over their business and talk about how big of an impact this global issue will likely have on them, give both a bearish and bullish argument for the stock, and of course share my personal opinion on all of it and let you know what I'm doing myself. Should be a very fun and interesting video. I hope you guys enjoy it. But with all that said, let's go ahead and get started. What's up everyone, my name is Ale, welcome back to my world of stocks. Okay, let's go ahead and start by taking a quick look at the stock and the valuation and their most recent earnings, and then we'll dive deeper into the business and talk about how it's being affected right now and how it will be in the future. Okay, now I've personally done almost all of my buying at under $100 a share through the years, which is where I've always felt very confident in the stock as a long-term investment. And that seemed like a great call on my part, especially in 2018 and 2019 when the stock continued to soar, eventually topping $150 a share. That is until 2020 when the market came crashing down and Disney was one of the worst hit stocks out there. At one point falling by close to 50%, all the way down to the $70 range, which is pretty crazy to think about. And in case you're wondering, yes, I did actually add to my position. I used my E-Trade account, for which I have a cost basis currently of almost $90 a share on that position. And overall, Disney is currently my fifth largest stock, just slightly ahead of AT&T. That said, the stock actually rebounded off of those lows right along with the rest of the market, climbing by over 36% to now trading north of $100 a share, which is already higher than the level I typically buy the stock at. However, they're still technically down over 25% year to date and close to 30% down from their all-time high. So what does that mean for the valuation? Well, first of all, you have to take future estimates with a huge grain of salt because it's almost impossible for analysts to accurately predict how everything is going to play out. We're currently living through a depression-like economy, and yet the overall stock market is only down less than 15% this year, which is basically just a routine correction that we see all the time, typically within like 1 or 2 years. And so while you would expect to be getting a great deal on Disney stock right now, it's actually valued pretty high in my opinion. Now, you're talking about a pretty high trailing P ratio of almost 20, which by the way uses earnings from the past year when things were still relatively good. And when you look at forward earnings, which during normal times the forward P ratio is supposed to be lower than the trailing because the economy I'm sorry, not the economy, but the company should be improving going forward. But Disney's forward P ratio is significantly higher at over 33, while the 5-year PEG ratio is also more than 5.5, which we typically consider that one to be good at around 1 or less. So it is significantly higher than that. So just from a valuation standpoint, Disney does look significantly overvalued right now, and that's because the business is deteriorating. Not only did their parks and cruises segments lose almost 60% of their operating income in the first quarter of this year, but that was only through March, which had only seen their American theme parks close for just a couple of weeks at the end of the quarter. On the other hand, the second quarter will likely include months of closure, with the rest of the year seeing significant headwinds that we'll cover in just a second. Still, sales for the first quarter of this year actually increased by over 20% year over year, but that was mostly thanks to the boost that they received from acquiring Fox last year. And because the company had their Shanghai park closed since January, and also because they've been investing so heavily into digital streaming, especially with Disney Plus, their net income actually crashed by close to 100%, which is a huge drop. Even on an adjusted basis, EPS was still down over 60% year over year, while operating cash flow, which is just the raw cash that you either make or lose from running the business and doesn't include additional investments like capex or even dividends, that was still down almost 20% year over year. So we're clearly starting to see the impact of the global health issue and what that's doing to Disney, which should intensify greatly in the next quarter, which, by the way, has already led to them furloughing over 100,000 employees while also cutting their dividend through the first half of the year in an effort to save as much cash as possible. It's not clear when the dividend will return at this point, as they're planning to reevaluate that in the second half of the year, but that's been a real disappointment to a lot of dividend growth investors, since Disney was an attractive, was once an attractive option with a low payout ratio and a decent growth rate to go right along with it. But clearly things are not looking good for Disney right now, and in order to get a better idea of what the rest of the year might look like, let's go ahead and break down their different segments and talk about how each one is getting hit and how they're being affected, and I'll give my opinion on each one as we go through them. Well, for starters, when breaking up their business by segments, media networks by far makes up the most of their sales at almost 38%, and that includes their cable TV companies like ABC, ESPN, or FX. And I'm not too worried about that part of their business, as it isn't really affected by people forced to stay home or social distance. But I will just note that there aren't many sports playing right now, so that could definitely hurt their ESPN business, which is something that they've mentioned. And of course, we're in a very deep recession right now, so advertising is going to be down throughout the year as well. But again, I don't think we're talking about completely non-existent sales, but rather just very weak ones throughout the year for that segment. Still, in the first quarter of the year, they were able to grow media network sales by almost 30%, but that was really due to the huge acquisition of Fox assets worth over $70 billion that gave them ownership of new networks like FX, and that helped boost the sales. Going forward, I still think the segment will struggle until live sports and advertising spend returns, but even then, ESPN and ABC will both likely continue to see declining viewership as more people continue to cut the cord, which is why they're investing so heavily in direct to consumer, which we will cover in just a second. Moving on though to the second largest segment, that's going to be parks, experiences, and products. And this one I do think will take a huge hit this year, as it is made up of Disney's theme parks all over the world, including the United States, Shanghai, Hong Kong, France, and even Tokyo, with resorts in places like Hawaii and the Caribbean. And it also includes their cruise line and safari as well, all of which are extremely vulnerable to people being forced to stay home or social distance, even when things open back up. Now, this is a very large part of their business at close to 30% of sales, and it was only down around 10% in the quarter, but that was because the US parks didn't even really shut down until the last 2 weeks of the quarter in mid-March. Now, the Shanghai park, on the other hand, did close as far back as January, but it's now expected to reopen in just a couple days from now, and that helped the stock rally as investors became more optimistic about the other parks following suit. However, it's important to note that the government is not allowing them to operate at more than 30% capacity, which would be less than 25,000 people per day, which is down from around the 80,000 that they typically see. So it is pretty significant drop there. And Disney said that they're even planning to operate well below that without reaching the 30% cap until several weeks from now in order to properly social distance at the park. Now, there's still no word on when other parks and even cruises will reopen, but Disney did mention during the earnings call that they expect a lot of pent-up demand as people are eager for normalcy, which is something that Disney feels they can offer. And hey, they might be right. Disney Shanghai actually sold out of their tickets on Friday morning as soon as they opened up, literally within minutes. Of course, part of that is definitely due to the lower capacity, but bulls feel that it's still a clear sign of pent-up demand. Back in the States, though, the California and Florida parks are still likely a ways away from being reopening, especially in California, which is kind of famously known right now for being stricter than maybe some other states out there. Disneyland in California is likely included in California's Phase 4 part of the plan, which does require therapeutics to be developed, but they're currently in Phase 2, I believe, and I'm not sure if by therapeutics they mean an actual V shot, which would obviously be, considerable ways away. On the other hand, Orlando's Orange County Economic Recovery Task Force, that's a mouthful, out in Florida, is saying that Disney World can open at 50% capacity in their phase one and 75% capacity in phase two, as long as they social distance and put in place other safety measures. I don't think phase one has started for that specific county yet, but I would imagine that it won't be too much longer. In fact, Rosenblatt Securities is predicting that the park will open as early as July, which does seem pretty close here to me. That would actually be at the start of the third quarter, so that would be pretty soon, I think. Either way, we're still talking about massive losses though in the second quarter, and probably continued pain throughout the year because of those capacity restrictions. But we'll talk about what kind of losses analysts are expecting in just a second. First, let's just quickly finish up the segments here, and coming in at number 3, that's going to be the new direct to consumer segment that does include the brand new Disney Plus streaming service, along with ESPN Plus and also Hulu, all of which can be bundled together for just $12.99 a month. So basically $13. And to give you some context there on how cheap that is, it's literally the same price as the standard version of Netflix, but you actually get 3 services instead of just one. Although I will admit that the Hulu version is ad supported, which honestly does kind of suck in my opinion. But of course, the segments continue to be the main, that segment continues to be the main growth driver for Disney, as they recorded over 100% revenue growth last quarter, partly thanks to people being forced to stay home. In fact, Disney Plus is like red hot right now. They're basically on fire, as it barely launched back in November, but had already grown to over 33 million subscribers by March, and then likely boosted by the stay-at-home orders, it soared to 55 million subscribers just 1 month later here in May. And when you combine their subs with Hulu and ESPN Plus, Disney now has a grand total of about 95 million subscribers, which is more than half of Netflix, which I know doesn't really sound that impressive to be half of Netflix, but you got to keep in mind how insanely large Netflix is. That's actually very impressive for Disney. Now, they also noted in their earnings call that they are seeing pent-up demand for sports content, since during the lockdowns, the NFL draft was the most watched in history, and the new Michael Jordan documentary called The Last Dance was the most watched ESPN documentary in history as well, and was also number 1 in the US across all key male demographics, all of which bodes well for ESPN once things start returning to normal. And finally, there's this studio segment that makes all sorts of huge blockbuster movies from studios like Lucasfilm, obviously behind Star Wars, Marvel, Disney, and now Fox after the recent acquisition, which did help them lift that segment revenue by as much as 18% in the quarter. But with theaters likely to either remain closed down or at the very least operate at extremely limited capacity, likely until a V-Shot is released, I would assume, that segment will probably get destroyed throughout this year. In fact, they said that they are now evaluating each movie release on a case-by-case basis going forward, with some either skipping the theaters altogether or at least being rescheduled to later dates for release. Either way, it's a huge deal for Disney, as they commanded close to 40% market share last year thanks to the acquisition of Fox. The next closest competitor was Warner Brothers at less than 14%. So this is huge dominance by Disney in the market, huge exposure there. And typically that kind of dominance would be cheered by investors, but given this very rough environment that we're in right now, many actually see it as a weakness. Having said that, what are analysts expecting in terms of losses for the year for Disney, and what does that mean for the stock? Well, let's quickly run through those numbers, and then I'll finish up the video with my overall conclusion and what I'm personally doing myself. Well, in the last quarter, every segment was actually profitable except for the new DTC segment, the direct-to-consumer segment, with all but one of them experiencing a very large drop year over year. Media was the only one that actually increased its profits by 7%, while parks crashed by almost 60%, studio dropped by 8%, and then direct-to-consumer fell by over 100% due to the continued investments into the streaming platforms. And again, I wouldn't be surprised at all if most of those continue to see huge drops like that throughout the year, especially in the second quarter. Speaking of which, according to Yahoo Finance, analysts are expecting more than a 100% drop in EPS for the second quarter, where they feel that it will actually be negative by a few cents. And if I did my math correctly, multiplying by outstanding shares, that would equate to around a $100 million loss in the quarter. And in my opinion, that does seem a bit too optimistic to me for the quarter. So I think there is some room to the downside there. And even for the full year, they're still expecting profitability of somewhere around $5 billion, which I also think is a bit high, although it is technically a crash of over 50% from the year prior, which is also coming off of another double-digit drop last year as well. So I guess it could be kind of argued there. 2021 though is supposed to be a lot better with a recovery of over 50%. And while I do think that's reasonable, as I still feel that 2021 will be a fairly large recovery year for most of the market, you're still talking about profits that are considerably lower than what Disney typically sees every year, and that doesn't really help with the valuation. But over the long term, it's hard to argue that Disney won't come back to their prior glory. There's clearly going to be a lot of pent-up demand for things to return to normal, and as long as the broader economy does eventually recover, then Disney should be one of the biggest beneficiaries of that, given how strong their brands are and the community attractions that they own. When looking at the Axios Harris Poll 100 that ranks the reputations of the 100 most visible companies in the United States, Disney actually ranked number 5 in both 2018 and 2019, which places them in the highest possible tier with an excellent score, and only a couple spots behind Amazon, and even higher than other very well-respected companies like Microsoft. Now, I guess you could argue that because Disney has such a great reputation, they will probably be more careful about reopening their business so as to not ruin their reputation, but I think over the long term, it's still a huge benefit for them and will help them stand out as a favorite choice among consumers who are looking for a sense of normalcy, whether that's in the movie theaters or at Disney's huge theme parks and resorts. And look, things could be a lot worse. At least Disney has their new streaming service up and running right now, and there's tons of content still coming to it in the near future, which I'm personally excited for all of the new Marvel and Star Wars shows like Moon Knight from Marvel, and of course Obi-Wan Kenobi, that show from Star Wars. But there's even such random additions as a new series based on National Treasure, so there's a lot of content coming. And while their streaming platforms are not currently profitable, the kind of silver lining for them during this whole crisis is that they will likely continue to gain huge subscriber numbers across the entire segment. And when those platforms do eventually become profitable, say within the next few years or so, they will be powerful competitors to something like Netflix and will ideally become cash cows in the future for the company, while also helping them transition from other legacy parts of their business that have been struggling. Speaking of which, keep in mind that with how much Disney is getting hurt right now, their market cap is actually very similar to Netflix. And don't get me wrong, I have nothing against Netflix, but they're really just a one-trick pony, while Disney is massively larger with various different parts to their business, all of which actually help each other pretty well and provide a ton of synergy, whether that's making blockbuster movies that later you can put into Disney Plus or into their streaming services, and the brands that they can use at their theme parks. Just a lot of synergy overall. So I just don't really think that Disney deserves to be trading kind of at the same valuation or the same market cap essentially as something like Disney, that just in my opinion isn't as big or broad or diversified company as something like Disney. So look, to summarize everything, I think the bears would mostly make the argument that the stock is just too high right now. The valuation is just too rich at these levels, considering how much exposure the business has to not just the global health issue, but also the macro economy. And I think that's a very fair argument. Now, on the other hand, I think the bulls would make the argument that this remains one of the strongest, largest companies out there with a proven track record of strong profitability and an incredible staple of very popular household brands that people will always be interested in, especially when this global issue passes, and it will eventually pass. And at that time, Disney will still be there as a solid long-term investment. So in my opinion, I think the bears really win the kind of short to medium term argument, while the bulls win the long-term one. And because of that, I have to go with the stock being mostly a hold at these levels, because there's just too much uncertainty surrounding Disney and how much damage their business will be taking. And because of that, I think the best prices really still remain at under $100 a share. So like in the 90s range, I think it's a buy. In the 80s, I think it's a strong buy. And then in the 70s or even lower, I think it just gets more and more attractive the lower that price goes. But above 100, I just don't see it being as attractive at those levels. And I feel that it's mostly a hold there because I already do own a fairly large position in the stock. Now, having said that, a lot of people always ask me, well, what would you do if you didn't already own the stock? And so my response to that is that if I did not own Disney stock at this moment, it's a very tough call, but I think I would probably be willing to buy a very small amount here, but with the expectation that the stock will go down so that if it does, I won't be so heartbroken or disappointed, and I'll be able to add to my position because it was such a small one, and I can lower my cost basis if the stock goes down, which I think is a very real possibility, at least here in the short term. And then if the stock was to just kind of stay stable and maybe even climb even more, then I at least have a small position in it that I can be happy about, and then I can look towards the future for any future corrections or market pullbacks to add to my position and build that up into a larger position over time if I still really like the company and the stock. But again, at these levels, it's a very tough call. I think there are safer options out there with more attractive valuations and possibly better upside potential, but I still think that over the long term, Disney will continue to be one of those proven companies that isn't going to disappear and will continue to have strong performance well into the distant future. And I'm very excited about some of the moves that they're making, especially with direct to consumer. So anyway, those are my feelings on Disney stock. Again, it's a very tough call at these levels, but let me know what you guys think about Disney right here, and if you either own the stock, if you're kind of holding, or if you're thinking about buying, if you will be waiting for a bigger dip, or if you're just kind of attracted to the stock at these prices right now. I would love to hear your thoughts down below, and I'll try to respond to as many as I can. Anyway, thanks again for watching, guys. It really means a lot to me. I hope you're all staying safe out there, and I'll catch you guys in the next one. Take care. Bye-bye.